In this video we will share the overwhelming evidence that suggests Aadi Biosciences' risk-reward profile is now truly compelling at $1.76 a share. Aadi's market cap is $43 million, which is less than 2 times its FDA-approved cancer therapies' current annual sales that generate 89% gross margins. Never mind, its market cap is also less than half of Aadi's net tangible assets, or its cash minus total liabilities, as of September 30, 2023, while burning about $15 million a quarter. An ongoing Phase 2 trial expected to fully read in 1H 2025 would, if successful, expand the label of Aadi's FDA-approved therapy by 28 times. This is because 28 times more patients would be indicated for Aadi's current FDA-approved therapy than today. It is otherwise not rocket science. After a first interim read on December 15, 2023, Aadi CEO said they were quote-unquote on the right path to meet FDA requirements for this label expansion. We suspect worst case the trial fails, then Aadi investors have to be bailed out by an outright sale of Aadi for say 2 to 3 times FYARRO sales, or $50 or $75 million, both higher than Aadi's market cap today. Best Care FYARRO's label is expanded. We'll demonstrate the potential Aadi upside from a label expansion using a couple of simple analytics in this video. We will provide detail on all of these data points. Aadi's net assets, current FYARRO annual sales profile, and Aadi's potential if its trial is a success. Put very simply, Aadi's upside appears gargantuan while the downside to patient investors appears minimal if Aadi is managed appropriately. Of course, there are risks to any business, including dilution risk and management incompetence. Also, in spite of the evidence we have presented and will present in the next few minutes, for all we know Aadi could trade to below $1 a share in the near term. We have no idea what is possible until Aadi's next inflection point in Q3 2024, when it is expected to provide a second data read from its ongoing Phase 2 clinical trial. This is why this video is for entertainment purposes only. This is not investment advice. Let's start with Aadi's market cap, which is only $43 million at $1.76 per share. There were 24.5 million common shares outstanding as of September 30, 2023, shown right from their balance sheet. Stock tickers today continue to note 25.5 million shares outstanding, so it appears there's been no material subsequent dilutive events. Since its merger with Airpio in August 2021, Aadi's share price is at its lowest price ever. There are also virtually no material dilutive securities until Aadi's share price is north of $15 a share. See here from their last Q, the only dilutive securities, per their dilution footnote, are 4.1 million traditional employee stock options and warrants to purchase 29,000 Aadi shares. The 29,000 warrants are not even a rounding error, and you see here from Aadi's stock option footnote the average exercise price on the 4.1 million employee stock options outstanding is $15.32 a share. As noted, Aadi's net tangible assets were $103 million as of September 30, 2023. Actually, don't take our word for it. We will show you in less than 30 seconds. Here is a snapshot of Aadi's balance sheet at September 30, 2023 per its Q3 2023 Form 10 Quetzales. Add the cash of $68.8 million to the $50.5 million in short-term investments plus the $5.7 million in accounts receivable and you get exactly $125 million. Now let's subtract Aadi's total liabilities of $21.5 million and you see how we calculate a hair over $103.5 million in net tangible assets, where Aadi's market cap at $1.76 a share is literally less than half of that. Aadi is burning roughly $15 million per quarter. Actually, let's also confirm that data point. Here we see Aadi's 3 quarters year-to-date loss from operations, also directly from its Q3 2023 Form 10Q, was $54 million, but add back $9 million in non-cash stock compensation expense. Simple math, that's $45 million in operating cash burn over 3 quarters, or an average of $15 million per quarter. We'll completely ignore the $4 million in interest income on their cash year to date that only reduces burn. Okay, we've made our point. Big picture, because Aadi's market cap is less than half its tangible value, this means the market is technically ascribing $0 in value to FYARRO when it is generating $25 million a year in sales at 89% gross margins. $25 million in annual sales may not be a rounding error to a big pharma, but nonetheless FYARRO is worth some multiple of sales because it has 5 patents that expire between 2029 and the year 2040. We suspect a consolidator like ASRT would gladly pay 2 times sales for a product like FYARRO. We're not suggesting Aadi's share price will move higher. We're just pointing out the risk-reward profile appears compelling via this one analysis. Now let's calculate FYARRO's annual revenue potential should its label be expanded if its Phase 2 trial is a success. Actually, to first provide a brief background, Aadi's FYARRO was approved by the FDA in November 2021 for certain soft tissue sarcomas, or PE-comas for short. These are ultra-rare cancers affecting at most 300 people a year in the United States. Still, Aadi got FYARRO sales up to $6 million a quarter by Q1 2023, where it has more or less stayed since. Analysts expect FYARRO sales to be in this $25 to $30 million a year range for the next 2 years. We can confirm gross margins have been roughly 89% all 3 quarters year to date in 2023, as you see here. Aadi is also studying FYARRO in patients with solid tumors that express what is called a TSC1 or TSC2 mutation. This trial will ultimately enroll 120 patients, 60 in TSC1 and 60 in TSC2. A first interim data read was provided on Friday, December 15, 2023. A second read will be provided in Q3 2024 and the final read is expected in the first half of fiscal year 2025. Per Aadi in the United States there are roughly 8,500 patients diagnosed with TSC1 mutated solid tumors and 7,500 a year in TSC2. TSC1 is the mutation where Aadi CEO said verbatim they were quote-unquote on the right path to meet FDA requirements for a tumor-agnostic label in TSC1. You can listen for yourself via this link at exactly 14 minutes and 6 seconds into the video. We would otherwise play the CEO's comments for you directly here to save you time, which is what we like to do, but we are unsure if we are allowed to as it is not our media or property to play. After Aadi published this first interim phase 2 data, the stock tanked in spite of the CEO's comment about TSC1. Apparently investors had anticipated better data. Now to be crystal clear, we have no clinical expertise in oncology, but, albeit the first read reported result of only 19 TSC1 patients, the interim read reported that FIRO scored a 26% ORR, or 5 of 19 patients saw their tumors shrink by more than 30%, also known as partial responses, a 42% clinical benefit rate, and FIRO literally shrank the tumors in 15 of the 19 patients after these 19 patients had, on average, tried 3 other FDA-approved therapies first. One patient saw their tumor shrink 90%. Again, we are not clinicians, but think about it. Yes, to be brutally transparent, we have no idea what investors were expecting, but was this data read that horrible? If you had a loved one with a TSC1 mutated solid tumor, would you not demand they be prescribed FIRO with these kind of results? Remember, FIRO is commercially available today. This is another reason why we believe Aadi's risk-reward profile is compelling. While Aadi may not promote FIRO for patients with solid tumors that express this TSC1 mutation, doctors may prescribe FIRO as they see fit. Okay, back to calculating FIRO's annual revenue potential should its label be formally expanded to this TSC1 patient population. We'll completely ignore TSC2. We will base the upside in TSC1 solely on FIRO's commercial performance to date and FIRO's current FDA-approved indication as a percent of the highest possible annual revenue potential in its current FDA-approved indication. This is not a perfect test but provides a barometer of FIRO's potential should its label ever be expanded to this TSC1 patient population. Let's start by calculating the highest humanly possible FIRO annual revenue potential per year at a 100% patient share in PE coma, a soft tissue sarcoma, which is FIRO's current FDA-approved label. We start with FIRO's list price at launch in November 2021 of $39,000 per month as seen here, and assume the average duration of treatment for every patient is a full 12 months and at a 100% gross to net. This is shown here by multiplying line I by row B and then again by row C. This means the highest possible net revenue per patient is $468,000 per year as you see here in row D. We are well aware this is not remotely possible, but bear with us. It is also likely FIRO's list price has only risen since launched, but let's leave that aside. Aadi has said, we've read on our own, that there are at most 300 people diagnosed with this PE coma or this soft tissue sarcoma per year. For this exercise to determine the highest humanly possible potential revenue in this indication, we assume FIRO gets a 100% share of this eligible patient population shown here by multiplying row E by row EFF or all 300 patients. Now if we multiply $468,000 by these 300 patients or row D by row G, we see that the highest possible annual revenues would be $140.4 million per year in this indication or label. We know FIRO is on track to generate about $25 million in fiscal year 2023 product sales. Taking this $25 million in actual annual FIRO sales and dividing it by the highest possible annual revenue potential, we see FIRO's actual sales, within 2 years of FDA approval, are 17.8% of the highest possible market opportunity in its current indication. We appreciate this is not perfect because the $25 million in fiscal year 2023 FIRO sales may already include off-label use. Also, this analysis uses the annual incidence of PE coma and does not consider the existing prevalence of the disease. This is why this is a directional analysis, but we believe is a credible data point to estimate potential. Let's now apply this 17.8% to the highest possible market opportunity in the TSC1 mutated solid tumor patient population. To calculate the highest possible FIRO revenue opportunity in TSC1, the only data point we change from the soft tissue sarcoma or PE coma calculation is the eligible patient population. We change soft tissue sarcoma patients of 300 patients per year to 8,500 patients per year in TSC1 per Aadi's estimate. Using the same logic and formulas as we did in soft tissue sarcoma, we see the highest humanly possible FIRO annual revenue potential per year would be just under $4 billion in TSC1, yes, assuming the patient population is 8,500 patients per year. If Aadi were to generate actual sales at 17.8% of this highest humanly possible TSC1 annual revenue opportunity like they have in soft tissue sarcomas, this would total $708 million in FIRO sales per year. Where is the flaw in this logic when assessing potential? Okay, if there is a flaw, then assume only 1/3 of this total is realistic, and we see Aadi could certainly be a thriving going concern with material upside if FIRO is ever approved in TSC1. This is otherwise known as the potential reward in Aadi's risk-reward profile. We'd add Aadi says they see the TAMs in both TSC1 and TSC2 in the multi-billions. Hence we find this simple analysis very interesting, but please discount our assumptions as you see fit. It is also very possible FIRO's label will not be expanded to TSC1 in spite of demonstrating a 26% ORR and a 42% clinical benefit rate, on average, a fourth-line therapy albeit in a pool of only 19 patients. Again, FIRO shrunk these TSC1 type tumors in 16 of the 19 TSC1 patients dosed to date in its phase 2 trial. My goodness, if you had a loved one with a TSC1 mutated solid tumor cancer, would you not insist if not demand they be prescribed FIRO if 3 other medicines were not working? Remember, though indicated for soft tissue sarcoma only, FIRO is commercially available today. Remember, all the same, we are not clinicians. We have no idea how a qualified physician or oncologist would read these results. This was a simple sniff test. We know the logic is not perfect and has flaws, but does it provide a somewhat reasonable barometer of potential should FIRO one day be approved for TSC1? Time will tell. A reminder, this video is assessing potential only and hence is for entertainment purposes only. This is not investment advice. Let's try a second test. We do not know FIRO's average duration of treatment nor actual gross to nets, but we can still calculate estimates should FIRO ever be approved in TSC1. Let's see what FIRO's revenue potential using various cases, meaning worst case, base case and best case assumptions. Let's again show best humanly possible case we just calculated next to these three. We start with FIRO's list price per month of $39,000 shown here in row I. This is a known data point. In row B, let's make assumptions around the average number of months a patient will take FIRO in TSC1. We know at most there are only 12 months in a year, so in worst case let's assume 4 months, base case 8 months and best case 10 months. Now in row C we must make estimates around gross to nets. The best humanly possible gross to net is 100%. As best we know, AADI has provided no gross to net data to date. It is our experience gross to nets for oncology-focused biopharmas is roughly 80% from peers like Urogen and Karyopharm. For worst case let's assume 70% gross to nets. For base case we will use 75% and for best case 80%. Okay, from these assumptions we can get to an average revenue per year per patient assumption by multiplying row I by row B and then by row C. We see in worst case we assume just under a $109,000 average revenue per patient per year. In base we get $234,000 per patient per year and in best we get $312,000. Again these, in theory, would be averages. Okay, now we need to estimate the number of patients that may be prescribed FIRO if hypothetically approved for TSC1. We know, or better said we're told by AADI, that there are 8,500 people diagnosed per year in the United States with solid tumors expressing the TSC1 mutation. Let's assume patient shares of 10, 15, and 20% in our cases. Could it ever be 40%? We do not know, but using these assumptions, when we multiply row E by row F in worst case we get 850 patients a year, 1,275 in base case and 1,700 patients per year in best case as we see in row G. Therefore, to estimate a range of annual AADI revenue potential from this potential TSC1 indication, we multiply the average FIRO revenue per patient assumption as we calculated here in row D by the estimated number of patients prescribed FIRO per year shown here in row G. Hence we see a worst case revenue per year of $193 million to a base case estimate of just under $300 million per year to a best case estimate of $530 million per year. Hence you understand why AADI could see huge valuation gains if ever approved for TSC1. FIRO is supposedly patented through 2040, so we suspect a multiple of 3 times is reasonable, consistent with AADI peers, certainly in M&A scenarios. This is what we mean by potential, again potential, reward. Watch our other videos assessing revenue multiples in oncology-focused M&A transactions. Okay, we've used 2 tests to get a sense of the potential AADI upside if FIRO's label is expanded to this TSC1 patient population. If there is a huge flaw in these tests, please note so in the comments. Now that we have estimated the upside potential if FIRO's label is expanded, and even though self-evident, let's do a simple AADI NPV calculation as of September 30, 2023. We showed you AADI's net tangible assets or cash plus accounts receivable minus total liabilities was $103.5 million. Let's then ascribe a value of FIRO at 2 and 3 times annual sales or $50 and $75 million. Adding $50 and $75 million to AADI's net tangible assets yields a NPV of $153.5 million and $178.5 million versus their $43 million market cap. By itself, this suggests AADI is trading at 28% to 24% of its September 30, 2023 net present value. Yes, 1 quarter has passed, so assume a conservative Q4 2023 cash burn and AADI still trades at a fraction of its NPV. If there is a flaw in our NPV calculation, please share with us in the comments. Remember, we could be very wrong, as anything can happen in biopharma. For all we know, a competing product in PE coma is about to be approved, so FIRO revenues could go to zero. This is why this video is for entertainment purposes only. This is not investment advice. For all we know, FIRO could also fail miserably in TSC1 or could show horrific side effects, in which case AADI could also go bankrupt. Most important, remember you could lose your entire investment when buying biopharma stocks like AADI. We are only assessing the risk-reward profile. We are not suggesting buying AADI stock unless you can afford to lose your entire investment. Okay, AADI has noted they have cash to last through 2025, though they did not say when exactly in 2025. If AADI had net tangible assets of $100 million as of September 30, 2023 and continue to burn $15 million per quarter, then simple math of dividing $100 million by $15 million confirms they had 6 quarters of burn remaining. This means, should they continue to burn exactly $15 million per quarter, they will run out of money by the end of Q1 2025. This is consistent with AADI guidance, but remember, cash burn could increase. Also, it would be irresponsible of AADI management to allow cash or liquidity to get too low. Hence a dilution of some sort is almost a certainty. Obviously we hope AADI secures non-dilutive financing like from a sale of future royalties. Our point being, absent gross AADI management incompetence, AADI should be able to net investors $43 million from a sale of the company with FIRO as a going concern if the phase 2 trial completely fails. This is why we believe the downside is somewhat limited, subject to 100 disclosures around risk. We'd point out once again that we thought the same thing with Aadi Biosciences ticker EIGR and we were dead wrong. Hence, if you risk an investment in AADI, invest only what you can afford to lose. We hope you learned something from this video. We'd appreciate genuine data-driven feedback on the assumptions used in this video. To be crystal clear, this video has been for entertainment purposes only. This is not investment advice. Please take a moment to follow us on YouTube, Twitter and StockTwits. Followers are humbly appreciated. Thank you.